we will call the meeting to order. First up, approval of minutes. Is there a motion to accept the minutes from January?
Thank you. I'll second it.
Okay, moved and seconded, all in favor? Okay, moving on to financial reports, January financial report.
I'll just give a brief. I have it on it. Okay, January and February financials, the income for January was $67,000, with the interest on loans being $18,000, bad debt recovery $2,500, income on investments was $46,000, and expenses were about $37,000, leaving a net income of $30,000. And for February, income was $79,000, interest on loans being $21,000, debt recovery $3,900, income on investments $48,000, expenses $25,000, leaving a net income of $54,463. The total income for the year is $147,000, and the total expenses for the year are $67,700, leaving an income of $84,000. And the balance sheet shows accounts receivable being $6,018,025, with investment accounts of $4,301,000, and with the inclusion of the long-term lease liabilities as total assets, liabilities, and equity, brings the amount to, on the balance sheet, $10,664,415.33.
Okay, customer loan reports.
So the customer loan report, the only one that is past due is the same one where we have a $491 balance. Everything else is correct. And we also did close on the two big loans we had been waiting for. So those came off of the loan committed list. So that was 302 Globe and
Downtown
Business
professional buildings.
Yes.
Any questions from anybody? Okay, is there a motion to accept the financial report and customer loan reports?
So moved.
I'll second. Okay, moved and seconded, all in favor? Aye. Okay, moving on to Bowers and Company. They're here to offer a brief presentation. I believe we'll turn it over to you guys.
Thank you. Yes, my name is Olivia Hill from Bowers Company, Liz Bush. So we're here to present the December 31st, 2025 audited financial statements. We have met previously with Joy Curley for exit conference. We've gone over these in detail. Overall, clean audit, no material entries, and not really any significant changes from what you're seeing today to internal financials. We also don't have any management audit with formal income or items from the audit, so pretty smooth processes here. So we will briefly go through the report. Page 1 starts the independent auditor report. On the top discloses our opinion, stating that the financial statements are really presented in all material respects. And the changes in net assets and net cash flow in accordance with accounting principles generally accepted in the United States of America. Overall, management is responsible for the preparation and fair presentation of the financial statements, and for designing, implementing, and maintaining internal control relative to preparing and fair presentation of the statements to ensure they are free from material misstatement. On page 2, it discloses our responsibility as the auditor. Our objective is to obtain reasonable assurance that the financial statements as a whole are free from material misstatement, whether due to fraud or error, and issue a report which includes the opinion we saw on the first page. Part of the audit process, we also identify and assess risks of material misstatement, perform audit procedures responsive to those risks, obtain an understanding of internal control, to develop our audit procedures, evaluate the appropriateness of accounting policies, and also conclude in our judgment if there is any substantial doubt about continuing operations for a reasonable period of time, which is typically 1 year from the report date, which the financial statements were issued dated February 27th, 2026. So clean, unmodified opinion. Looking at the first statement on page 4 is your statement of financial position, or your balance sheet, the top section, your assets, overall total cash and investments, net increase of about 21% from the prior year. Loans receivable increasing, which we'll see breakdown on that in the footnotes, just over $5 million at the end of the fiscal year, with total assets of about $10.6 million, which is up 3% from the prior year. You have outstanding liabilities for your operating lease liability, which is disclosed in the footnotes as well, relating to your office space. And the related lease term for that of $267,000, and the difference in your assets and liabilities is your net assets, all without doing a restriction of $10.3 million, which is up 3% from the prior year. Page 5 is your statement of activities, the profit and loss statement. So for revenue, your interest on loans down about 4% from the prior year to just over $263,000. Positive return overall in your investment portfolio. So overall, total support and revenue increasing about 1% in the current year to just over $645,000. Your expenses, which you'll see full detail of on the next page, for $304,000 in the current year. So a positive change in net assets for net income for the year of just under $341,000. The statement of functional expenses on page 6 requires the nonprofits a full disclosure of all of your expenditures broken down in actual classification. So the top salaries and related benefits down 12% from the prior year. Your credit loss and recoveries relating to your loan portfolio and your allowance, we'll see the roll forward of that. But that did represent a recovery of about $18,000 in the current year compared to a recovery of $253,000 in the prior year. Overall, though, 64% of your expenses are relating to your program operations and 36% for management in general. Page 7 is your statement of cash flow. So the financials prepared on the accrual basis of accounting kind of shows you the actual cash flow in and out. So the change in net assets or your net income at the top, less non-cash items for depreciation and changes in your investment portfolio, and the changes in your receivable and payable items from the statement of financial position. So overall, you did have cash provided by operations this year of just under $125,000, and then cash flow from investing activities. Your loan originations in the current year of about $480,000 of cash out. Changes in the investment portfolio overall, but overall positive cash provided by investing activities of $575,000, with a net increase in cash of just over $700,000. And also the financial statements are consistent with what you've seen in the prior year. There's no changes in accounting standards or policies that impact the financial statements in the current year, so I will just highlight a few of the main items from within the notes. The first being on the bottom of page 11, the concentration of credit risk. So the cash balances at financial institutions covered by FDIC limits of $250,000. Disclosing that there was about $509,000 deposits in excess of that, which were not covered by FDIC limits. And then all the balances in the RBC accounts are covered and collateralized by SIPC coverage for other program banks with FDIC coverage. And then to page 13, note 3 summarizes required disclosures on your loan portfolio. So on page 13 here, you will see the outstanding balances of your loans, about $5.3 million in the current year, overall decreasing about $646,000 from the prior year, and on the allowance reported against the portfolio of about $207,000 for the net balance outstanding receivable. On page 14, you'll see the age analysis. So as far as the current report, you've got one loan for $492, which is greater than 90 days past due at December 31st, and the remaining portion of the portfolio is all current. And on page 15, you'll see information on the risk rating credit quality structure to calculate the allowance was classified as satisfactory, watch and substandard, and then how that pulls into your actual allowance in the lower and the allowance on the lower portion of page 15. So overall, you had recoveries of about $39,000 on the portfolio, credit loss or actual loan write-off of $58,000, and a provision to gross up the allowance based on those credit quality factors, which is reflected, as we saw in the statement of functional expenses, as the credit recovery for the net balance of $18,000 in the current year. Note 5 discloses information on your temporary cash investments, so those for accounting purposes are in CDs with maturities greater than 3 months. So those having a fair value of just over $1.1 million. And then other information on your investment portfolio in note 6 on page 17, comparing cost to fair value with overall appreciation of about 21% return to date on that cost to fair value comparison. Note 8 on page 18 summarizes your operating lease. So based on the office space lease, which is a 10-year lease with 2 5-year renewal periods, that is a present value calculation of future lease payments, which we saw in the statement of financial position as a right of use asset and then a lease liability for the term of your lease, with operating lease expense in the current year recognized of just over $22,000. The last disclosure I'll highlight is note 11 on page 20, required disclosure for nonprofits in regards to your liquidity and availability of financial assets. So that summarizes all of your financial assets, less any that are unavailable for general expenditure within 1 year, being items that have liquidity horizons greater than 1 year or loans receivable that will be collected beyond 1 year. So overall, you have about $2.6 million of financial assets available to meet general expenditures within 1 year. In the back of the bond packet, we also are required to report returns from government auditing standards. So there is a report, independent auditors report on internal control over financial reporting. This report does not have an opinion stated within. But on the top of page 24, it does disclose that during the audit, we didn't identify any deficiencies in internal control that are material weaknesses. And our test disclosed no instance of non-compliance in accordance with government auditing standards. So previously mentioned, the Clean Auditor is now a general management letter. The loose leaf letter in the back, there's a one-page report, which is required according to your Paris investment report with the Authority Budget Office, and then the communication with governance letter. So that discloses some of the required communication that we report to you, that there's overall no new accounting policies adopted in the current year. There are accounting estimates that are an integral part of your financial statements based on assumptions and expertise, current events, future events that management uses to make those assumptions. So those estimates that are within the financials that we just saw is your allowance for credit losses, which is based on profitability of your loan portfolio, depreciation based on the estimated useful lives of capital assets, the present value calculation for the right of use asset and the lease liability, and then also functional expense allocation based on time and effort on the statement of functional expenses. But overall, we're pleased to report there was no difficulties performing our audit. We did not have any disagreements with management. We did not have to consult with any other independent accountants who could issue the audit report. So overall, we came smooth audit process. The tax return has been prepared as well and has been filed. So all the reporting is
Okay, very good. Any questions from anybody? So we'll need a motion, correct, to accept this. Is there a motion to accept the report as presented?
Make a motion.
Is there a second? Second. Okay, moved and seconded. All in favor? Aye. Thank you very much. Thank you. Okay, moving on, we have an investment update from RBC.
Thank you very much. Thank you for having us, and congrats on a great audit. So, a couple of things I'd like to always start with, if you would allow me, just to give you a little history for those who, have not been around this table for a very long time. your account way back then was CDs. And then over the years, we started looking at ways to increase the yield of the account, etc. So we went from 3-month CDs to a little longer term CDs. Then we said, well, okay, let's use treasuries. And we went, and your board was very accommodative, and your executive team was accommodative in adding to your investment policy some corporate bonds. So we started using corporate bonds to increase the yield a little bit. And time went by, and then you were so flexible to allow us to use with limited possibilities, equities. So now you do have some equities. What we do, we like to always include your investment policy under the last tab of the presentation here, just so you know where you are. And as far as we're concerned, everything we do for you is cash flow driven. So we're not sitting here trying just to maximize return, have a conversation with Kylie every month or so. We look at all the loans that you have to pay. She looks at all the cash flow that she has at the bank, etc., what we have with us, and we make sure we match your cash flow needs with your investments. So the investment is never driven, just, invest and get me as much return as you can. It's always cash flow driven first, and then we put, the pieces together. We monitor very closely, and John, watches this like a hawk to make sure that we don't breach any of your investment policy limitations. So we have limitations per stock, per sector, per bond, quality of the bonds, etc. So, I'm pleased to tell you that we are 100% in compliance with your investment policy. But interestingly, you will see that in the last few years, the performance is better than the long-term returns, hence why you guys allowed us, and thank you to introduce this. So you helped a lot the performance, and you will notice from your audit, most of the gains, as you expect, come from the equity side. A lot of the equities that you have, again, we did not go with growth, we go with income, because your bogey back in the day was 5%. I don't know if it's still, what is the rate that you're lending at? Is it 6 now?
Yes.
6%. So this was the bogey, basically. And so we will look to replace that income while it's sitting on the books, because you're not in the investment of investments, you're in the business of lending money, but while your money is sitting, we do that. So before we go into your portfolio and the numbers, etc., questions, concerns about that, thoughts? Okay. So if we go under your presentation here, there's a nice summary about our feeling on the market, etc. And you will hear about it 722 times a day. It all depends on what's going to happen in the Middle East. How long will this mess go on? Will the price of oil remain over $100 for an extended period, or will this be sorted out in 2 weeks? And that will dictate, what happens with inflation. As you know, inflation is the most important factor for everything we do for you, on the bond side and on the equity side. So it is critical. In general, in the United States, luckily, less than 5% of the average consumer goes to energy costs. So that's okay. But as you know, there is energy costs in every single thing that we use, whether it's plastics, whether it's whatever, transportation, etc. So it will affect the economy if this takes on for a long term. But again, we are eternally optimistic, and as long as we are cash flow driven, all of that is noise. So we're not too concerned about that. In the long run, we have a business to do to make sure that we're investing based on cash flow. So again, our expectation, we can talk about it, but it varies a lot based on what's going to happen and the length of this war, basically. So if we go to tab 2, and you can read a little bit about RBC's research on all that. If you can't sleep at night, that'll happen.
This month does have its feature is the Iranian conflict and potential possibilities, but who knows?
The spectrum is very wide. If I was to be a guessing person, I would say nobody can afford to let this thing go on for a very long time, whether it's us or them. They need the money more than we do, and we don't want to have more casualties. So I think at the end of the day, this hopefully will get sorted out sooner than later. So if we jump to your portfolio, tab 2, page 3 of 14, you have your total account. The reason why you have 2 accounts, one of them is the fixed income where we have the bonds, CDs, etc. The other one is your equities. So the total is $4,420,000. If I turn the page, about 65% of the portfolio right now is in fixed income, and 25% basically is in equities, and 10% is in cash or equivalents. So we leave the cash because you have some distributions, etc. usually, but we are trying to minimize the amount that you have in cash by using T-bills. So we use also T-bills, short-term T-bills. They tend to pay a little bit more than money market. At least that money is collecting 3.5, 3.6, whatever it is currently. I mean, so we try to increase as much yield as possible. Interestingly, just to show you the history that I was talking about, under page 5 of 14, you'll see that back in the day it was almost all fixed income based on the colors, and now it's coming down a little bit since you allowed us to use a little equities and a little corporate bonds, etc. And by doing that, you helped the organization tremendously. So as a team, you've done an excellent job for the organization by doing that, and John will talk about the numbers later, etc., about how this went by. So under page 6 of 14, just a couple of items here. It shows you the top 10 positions. What it tells you is you do not have an individual stock in this portfolio over 1%, which is what the mandate is in the investment policy. So if we made a mistake, it will never jeopardize the portfolio. On the right-hand side, you will see your top 10 winners. Interestingly, last year, Corning Glass was the best winner in the portfolio, 87%. This is, in our backyard. Toronto Dominion Bank, the prior year we bought it in your portfolio, sold off. They told them you cannot do business, this and that, for whatever. They restricted them, the stock tumbled. We knew TD very well, and you've done 83% on top of a dividend of 4% on that. So it's been phenomenal. 5 below, those, the shoppers would know that company. Have been on fire, as you know. Google is Alphabet, had an amazing system. BAE Systems, of course, with defense in Europe, thanks to our president. I mean, BAE Systems did extremely well because they cannot keep up with demand. Raytheon, again, on the US side, done very well, etc. Eli Lilly, drug law, weight loss drug that, seems to be doing extremely well. And we finish with a couple of resource and commodities, and Ulta Beauty. Those of you here also might know that stock very well. So anyway, to talk about the portfolio does not look like the S&P 500 on purpose. The S&P 500 right now between technology and telecom is 44-45%. And those do not pay almost any dividends. And in this portfolio, we're after dividends, hence why you see an underweight in information technology, 18%. With communication services, you're at 27% compared to 45%. This is not by accident, this is by design, because this is an income-oriented portfolio. Then you will see you have a nice diversification between large cap, mid cap, small cap, and real estate, etc. So you're very well diversified there. And for a long time, we could not get long-term bonds and get you decent yield. Finally, rates moved up. So now we can buy longer bonds and put them in the portfolio and get you decent yield. So we moved in that direction a little bit. And what is very important, again, is for you to have the cash when you need it. So if you look at page 8 and page 9, this portfolio generates $120,000 in income per year total. So about $10,000 a month that you can use for the operation, or if you don't need it, it's being reinvested. On top of that, like in 2026, on top of the cash that you currently have, you have $870,000 maturing. In 27, 475, 28, 375, etc. And if you need them, we have a system now where we could sell more than what is maturing. We're not in the business of buying and selling bonds. We usually keep them in the portfolio because 95% of return of bond comes from the interest. But if you needed the money and there was a big project, we can, use some of that. But the nice thing about it, it's a nice ladder. You don't want to have everything mature in 6 months or a year because you have that reinvestment risk. So we have the flexibility of going a little longer, but again, I go back to the square one, cash flow driven. So everything is based on what projects are happening. If projects are slowing down, we can go longer. So
take a second, just on reinvestment risk. It's a term we're very familiar with, but just in case it's something new to you. Basically what that means is if everything is involved or invested in very short-term bonds, you're taking a risk that if bond yields were to drop by the time your bonds mature, you're staring at a landscape where you're not going to get the same income. So we've taken advantage. While most of it is very short term, we do spread it out longer term, looking to lock in what's currently a higher yield environment. You remember the 2010s, you were getting 0 or 1% across the board. We don't think that's coming, but nonetheless, you don't want to take that risk that you have all this money invested short term, and at the other side, there's not a lot of income at the end. That's why we spread it out a little bit.
Yeah, so in terms of the performance, that'll be page 10 of 14. And again, this is as of December 31st, because we're here to review the data as of 12/31/2025. So it matches the audit that you just saw. So again, if we look at the year to date, or 1 year will be the same thing, the portfolio is up about 8%. The 3 years on average, 7.83. And then you will see the longer performance have been lower in the 3s or since inception 4%. Interestingly, as you remember, there were times we were buying CDs at 1% and 1.25% a few years ago. Some of us forgot about it, but we did not. So that kind of skewed the numbers lower. Luckily, you know, we did other things as well. So the last few years have been much better since we introduced the equities. The good news here, if you look at your portfolio since inception, you have 4,420,000. Out of that 4,420,000, 3,087,000 came from growth and income. So really, this portfolio, your net cost on it is $1,400,350. So you see the blue line, the light blue on that is your net investment in this portfolio. The dark line is the value of the portfolio, and the delta is that $3,087,000. So this has worked extremely well for you, so you can do a lot of good in the community thanks to your investment returns over time. So that's basically, in a nutshell, when we look at the overall picture. Questions, concerns? So John, do you want to get into the stress test, or do you want to go into each account first?
Stress test, I think, if we look at the 75% of the portfolio that's very short-term bonds or longer-term bonds, we put together a stress test behind tab 4 that looks at, okay, what happens over the next 2 years under varying scenarios for the bond investments and the CDs. So if you turn to page, both 4 and 5 give you some information. Page 4 defines what these are, but basically we have the scenarios looking at page 5 near the top. They go from left to right. If rates do not move, that's considered parallel, and this is over 2 years. What if they go up 100 basis points, aka 1 percentage point? What if they go up 200? That's usually bad for bond portfolios because what you're holding yields less than the new stuff. But what happens if they drop? That's scenario 4. And then what we call a flattener. That's unlikely to happen. Interest rates from the very short term to the very longer term are pretty flat right now. It's hard to get more flat, but we also put in a steepener. What that basically is, if short-term rates come down and long-term rates go up, what happens to the portfolio? So if you look at this scenario, basically what you'll see is if rates drop, if rates go up, you don't sell your bonds. But if rates drop or sell, have them called. If rates go down and your issuer can give you your money back, they're going to do that and reissue that debt. So you see how there are a lot of different dynamics as you have maturities throughout this. This report looks at the actual bonds you have. And over the next 2 years, you'll have plenty of them, almost 800,000 maturing this year. It replaces those bonds or CDs with investments that go to the end of the 2-year term. So that's kind of how it's getting the portfolio invested the whole time. But what you can see across the different scenarios is there are some differences in if the return comes from income or from growth, but you're seeing positive return over the 2-year period in any scenario, and quite strong. A reminder, this is 2 years of return, so it's not 9% a year, but about 4.5%. But if things stay steady, I'm looking in the middle at projected return performance. Total return, 9.15%. If rates go up 1%, that is going to hurt the value a little bit, but still, 8.58% return over that 2-year period. Again, as Cyril mentioned, the vast majority of your return on bonds and CDs comes from the income that they pay you. Up 200 basis points. Okay, 7.94. You did lose a little bit of return because your bonds experienced a little bit of price depreciation, but still you did quite well. If rates go down, it's even better, 9.51%, your bonds appreciate. So under any scenario, even in a rising rate environment that hurts your bonds, you're still getting that income. You're not seeing tremendous, because the portfolio is pretty short term, you're not seeing tremendous adjustments in price. This is something we run for ourselves from time to time, usually twice a year, to look at the portfolio, see how it would work, and we run different scenarios under it. But very strong performance.
Thank you, John. And again, I'm not going to take too much time going over everything, but under tab 3, let's jump quickly to page 10. And this will be if you wanted an attribution report, so clients would tell us, okay, well, show me what happened on the fixed income only, show me what happened on the equities only, that's what you're looking at. So on the fixed income only, last year, it gives you the 1 year performance, it gives you a 7.3. So last year was very unique because interest rates went with us, so that helps. So as you know, when interest rates go down, the value of your bonds go up and vice versa. 3 years performance, 5 years, etc., 10 years. You can see in the long run, I mean, we did okay, but we were talking in the twos. I mean, 2% and last 10 years, 2.5. So really, most of the money performance came from your equities. If you look at your portfolio holdings under page 11 of 15, you will see that a lot of them are new because we keep on reinvesting bonds. Every time something matures, we reinvest. So a lot of the purchase dates are fairly recent because, you know, that bond portfolio is pretty active. And one change that we did before, I used to have to call every time to get authorization every time we have a CD that matures. Thanks to your approval, now we're able to do it automatically, so there's no money sitting in the account idle. Always cash flow driven, like I said. Now, interestingly, if I jump to tab 5, which is the equity, and it shows you now where is the growth in the equity section, and then you go to page 10 of 16, and you can see where the real returns came from. So like last year, year to date was 15%, 3 years on average 14% per year. That's phenomenal. 5 years 9%, 10 years 9%. So it's been an amazing run on the equity side. So that has helped you tremendously. So again, I'm not saying we should go all equities. I think for the objectives that you have, we review very carefully your investment policy. The last copy we have is from 2020. I think it's the last one. I don't think there was any other amendments. And in our opinion, it's still very appropriate. I have the last amendment from 7/30/2020. Is that the last one? Do you know if there's anything after that? I don't think there was. And honestly, I still think it's fine. We don't need to get more aggressive at this stage of the game. I wouldn't be comfortable myself knowing what the mission is of the organization. It's not, you know, we're not trying to create wealth here. We're trying to cash flow this operation basically. And so we're very comfortable with the investment policy. We would not recommend changes right now. It is not restricting us in any way, shape, or form. And I think John also printed this additional page in your package just to tell you where are we year to date, because people are worried did we lose everything. So I want to take a second and
And so
comment
this is
on where we
just
are.
as of yesterday, and you can see year to date, the portfolio is actually up. And it dovetails a little bit. It's mostly a bond portfolio, so it's not going to be under pressure when stocks are selling off. But also, the way the stock portfolio is composed, that's actually up as well. We haven't been down in the stocks. It's actually up about 1.7%. And something I thought was interesting, if you look at the 3-year gain and loss plus income, 964, almost $1 million in growth over the last 3 years, that 25% stock has done about half of that. So that's where a lot of the growth has come from, but still a solid portfolio. It's built to not feel the stress of these sorts of environments, and we are currently up for the year.
Yeah, it's interesting. People tell me, oh, there's a lot of volatility. Well, thank God for volatility for people like us. This is how we stay in business. Because volatility for us is opportunity. So a few years ago, we were buying in your portfolio the oil and utilities when nobody wanted them. Everybody had to own NVIDIA. If you don't have NVIDIA, you're gonna struggle. Well, guess what? Lately, we're taking profits from your Chevrons and your Exxons and your oils right now and your utilities. And you know what? If these other guys sell off, we will get it. But I mean, one exception I told you, Corning, that's one that we are selling. We have been selling because it's getting a little crazy. We bought some at $38 last year. It got to $154. So at a certain point, you know, get it. So we monitor all that very carefully, and you know, we appreciate the business, the trust, and anything we can do. I mean, our names are on this packet. If you have any questions right now, we'd love to take them. If not, you can address us later on any issues or anything that you think we can do better for the organization.
Any questions from anybody?
I'm sending you that investment policy just so you can just.
Is there an
It's
amendment?
whatever. It looked like it was adopted in 23.
Okay.
So.
But I don't have any changes or
But
made to it.
changes might not have been made,
Okay.
so, because.
It's good practice just to look at it.
No, we
We'll
look, yeah.
we'll compare them if there's any
Yeah.
issue for us to know, because we're using an older one, so that, thank you.
Yeah,
We need to
we
be
always
good.
have them on our website too, because we
Okay.
have
Okay,
to.
okay.
New York
If we see
State.
something, we'll let you know, and if there's any adjustment needed, we will take care of it.
Right.
Very good. Thank you very much. Appreciate your time this morning.
Thank you.
Happy spring, hopefully. All right.
Apparently the internet's not, I'll do it when I get back to the office.
Thanks. Have a good day.
Have a good one.
Such a long one.
I think this dreaming is the thing that's sucking everything out.
All right, moving on to committee reports, loan review committee.
So Marshall is not here.
Right, and I wasn't at that meeting.
So we have to ratify the treehouse. So that was the 180,000, it's for 1 year interest only, and then with a balloon payment after the 1 year. As of right now, the IDA did approve 30,000 to go towards it, and then I'm still under the impression that NCA is taking the 60,000 tomorrow. Thursday.
I heard 30. I thought Matt said there, it looks like it's 30, but we can double check.
Okay, because when I talked to him what day did I talk to him? I don't know, last week after the
Last
meeting. it was
Thursday.
60,000.
Oh, was it? Okay.
Yeah,
All right.
so I'll keep you updated on that one. But we had voted via email on this, we were aware that we may be using the full 180,000. As of right now, we're doing 150,000 of it. We have extended 45,000 as of now, but we just need to ratify the original approval that was done via email.
Okay, so is there a motion to move forward with what's being proposed for the treehouse? Okay, is there a second?
I'll second.
Okay, moved and seconded, all in favor? Aye.
And then, in March, we met about Sub Rosa Collective Cafe. This will be located up in top of the square. It's for 50,000, to be amortized over 5 years with 3 months interest only. The loan application fee is $750, or the loan fee and the application fee is $100.
And collateral would be on the.
Yes, and we
equipment.
did not have collateral listed on here. The collateral will be all furniture, fixtures, and equipment.
What's the interest rate? 6, right?
Yep, 6%.
Okay, any questions on this one for discussion? Okay, is there a motion to approve the loan for Sub Rosa Collective Cafe?
Yes.
Okay, second?
I'll second.
Okay, moved and seconded, all in favor? Aye. Okay, moving on to governance.
Governance Committee met on March 11th for the purpose of reviewing what's referred to as the confidential board evaluation, which really equates to a self-assessment. This is required by the state, but is considered a best practice for nonprofits. We had 8 respondents, and you have a copy in your packet. We felt the overall response was very favorable, with the vast majority agreeing with all of the statements, and just a few that checked off somewhat agreed. We heard as part of that meeting that Kylie and Joy are preparing a board manual that will be available in electronic and paper form, that we feel strongly, all of that information's out there, but they're going to consolidate it into one place, which we feel strongly might help provide additional insight when folks are filling this out in the future. So I believe the motion that we're putting forth is to recommend approving the results of this evaluation so that you can then submit it to the state. Is that correct?
That's correct. It's just a
Thank you.
box we have to
Yep,
check.
understood. Thank you.
Okay, is there a motion to that effect? Okay, moved and seconded, all in favor? Aye. Okay, moving on to new business, is there any new business from anybody? Okay, CEO report?
So the last 2 months have been pretty busy between the audit and I think I've had 3 JLI days. And lots of site visits, so we've done a lot of, just follow our social media, you'll see a lot of pictures that we've been doing. Ally's been amazing. Hopefully we'll stop into some other businesses next week as well. We had the audit exit interview, which went really well. I think those are the highlights of it. It's been really busy. That's it.
Any questions for Kylie? All right, old business, is there any old business? Okay, then, is there a motion to adjourn?
And I'll second it.
Okay. All in favor of adjourning?